Do you need financing for your new home purchase? Do you need cash? 10 financing options to consider when buying your new home, including a few options when you're in need of operating capital. When you are ready to look for a new home, the first thing you need to consider is, what can I afford? Where is the money going to come from? And who do I turn to? So, you're ready to buy a new home. Maybe you are a first-time home buyer, or you wish to sell your existing home to relocate, and you're wondering about financing options, or maybe you have a business, or you are an investor, or you are someone that just is in need of additional cash on hand and would like to know where to turn to for assistance. Well, would you like to learn more? I am Dr. Ron Repacy, your real estate doctor with Realty One Group Paradise here in sunny Naples, Florida. And it's about time to share some thoughts with you. And so let's dive in. In life, and also in business, there often comes a time where added capital and cash infusion may be needed. In this video, we will discuss some options that your lender may present to you when it comes to financing your home purchase. Additionally, we will touch on a few options to consider for your business or anytime you're in the need of additional personal funds, whether you have a lot of money or a little, low credit score or high credit score, lack of income, or even a bankruptcy. Number one. Conforming conventional loans. Conforming conventional loans. This is one of the most common loans that people turn to when buying a residential property. You are probably familiar with the term Fannie Mae and Freddie Mac. Well, these two characters play a role in government-backed loans. These loans can at times require as little as 3% down and a credit score currently between 620 and 640, depending on the lender. And they also have loan amount limits. Number two, non-conforming conventional loans. So non-conforming conventional loans. These loans are often offered to borrowers with a low credit score or someone that has a new mark on their credit or bankruptcy. These loans exceed the FHFA, Federal Housing Financing Agency, conventional mortgage financing limits. That's a mouthful, right? So again, these loans exceed the FHFA, Federal Housing Financing Agency, conventional mortgage financing limits, and do not meet the standards of Fannie and Freddie. These loans generally have a higher interest rate and a higher down payment than conventional loans. Number three. Jumbo loan. A jumbo loan is a loan that covers a larger than normal loan amount. Here in Naples, I believe here in 2022, the loan amount is above $647,200. These limits are set by Fannie and Freddie. Jumbo loans typically have stricter underwriting guidelines and they pose more risk to the lender, but many times you can get very competitive rates. Number four. Fixed rate conventional loan. This type of loan is best if you're planning to stay in the home for a long time, as your interest rate will stay the same for the life of the loan. That's a key player in it. You may pay a slightly higher rate, but there is no risk or surprises. And so this is a very common loan to choose. We're going to move on to number five. Adjustable rate conventional loan. An adjustable rate conventional loan is just that. The interest rate may be locked for, say, a period of 3 to 5 years, depending on the loan terms you decide. But after that fixed rate period, the loan goes up and down according to market conditions. So this type of loan is commonly used if you're planning on staying in the home for a short period of time, as opposed to the fixed rate. So an adjustable rate conventional loan is commonly used if you're only planning on living in the home for a short period of time. We're going to move on to number 6, FHA Loan. U.S. Federal Housing Administration is a mortgage-backed mortgage loan that is provided by an FHA-approved lender. FHA mortgage insurance protects the lender against losses. These loans require a lower minimum credit score and a lower down payment than many conventional loans. These loans are insured by the government, but administered by third-party lenders. FHA loans are 15 or 30-year term loans with a fixed interest rate. Borrowers that put less than 20% down are required to purchase mortgage insurance at an additional cost. The property may meet FHA criteria and cannot be used on a second home and investment property. So they must meet the criteria of the FHA and they cannot be used as a second home or investment property. So moving on to number 7, USDA, also known as the USDA Rural Development Guaranteed Housing Loan Program. USDA is a mortgage that is offered to rural property and is commonly used for lower income borrowers with an interest rate as low as 1%. If you qualify, there can be a 0% down payment like the VA program, which we're going to talk about next. So VA loans. A VA loan is a mortgage guaranteed by the U.S. government, the U.S. Department of Veteran Affairs. It's exclusive for military borrowers to buy and refinance their homes. VA loans are eligible to active duty service members, veterans, and eligible surviving spouses to finance a home with no down payment, no mortgage insurance, and lenient credit requirements. Not only do VA loans require no mortgage insurance, the closing costs cannot exceed 1% of the loan amount. The last two types that we're going to talk about are used for a wide variety of financing needs outside of a home purchase, potentially. And number 9 on this list will be a HELOC, Home Equity Line of Credit. Is a loan which the lender agrees to lend a maximum amount within an agreed period where the collateral is the borrower's equity in their home. In order to obtain a HELOC, you would have already had to own real estate, as this type of loan allows you to borrow equity from your existing piece of property or your piece of real estate. Terms can vary and can be up to 30 years, and the interest rate is a variable rate, which is important to note. There are a number of risks since you are using your home as collateral, but the HELOC can be a way to pull out cash from your home when you're in need of cash on hand. Banks typically limit the amount you can borrow to around 85% of the appraised value minus the amount that you still owe on your mortgage. Moving on to number 10. Alternative lending or hard money. A hard money loan is a specific type of asset-based loan financing through which the borrower receives funds secured by real property. Hard money loans are typically issued by private investors or companies. Alternative lenders must consider your home equity, debt-to-income ratio, known as DTI, and loan-to-value, LVT, loan-to-value ratio, and other factors. Once approved, hard money loans can be issued very quickly. The trade-off for faster turnaround times can be a higher interest rate and origination fees. Overall, hard money loans are more expensive because of the higher risk to the lender that they are taking on in offering these loans. I am an affiliate with America's Business Capital, which offers alternative lending with a wide product range, including bridge loans to working capital, merchant cash advances, purchase orders, receivable factoring, corporate finance, and lending on commercial and residential real estate, and much more. Alternative lending becomes very valuable, especially when funds are needed quickly. Even though the rates may be a bit higher, hard money offers another form of obtaining financing. And if you have any questions in this area, feel free to contact me. So let's just quickly review. So again, the title of this was, do you need financing for your home purchase? Do you need cash? So again, we were looking at 10 options to consider when buying your new home, including a few options when you may need some operating capital. So number 1 on the list was conforming conventional loans. And this is one of the more common type of loans. These loans can require as little as 3% down and a credit score above 620 to 640, depending on the lender, and they do have loan limits. Number 2 that we talked about was non-conforming conventional loans. This can become valuable if you have a mark on your credit score or a bankruptcy. These loans generally have a higher interest rate and a higher down payment than the conventional loan. When we talked about a jumbo loan, A jumbo loan is where lenders may offer loans at this point above $647,200. And so underwriting guidelines may be a little bit more strict as the lender is taking on a little bit more liability. And at the same time, you may be able to get similar competitive rates. Number 4 was a conventional fixed rate conventional loan, fixed rate conventional loan. And this type of loan is if you're planning on staying in a home for a long time. So that was the key to that. An adjustable rate conventional loan is just that. The rate can adjust. You may have a fixed rate for 3 or 5 years, and then you have an adjusted rate. And so this can be a choice when you're living in the home for a short period of time. So that's an adjustable rate conventional loan. FHA loan is a mortgage-backed mortgage loan. These loans are insured by the U.S. government and administered to third parties. So you would have to get assessed and go through an approved FHA loan lender. USDA loan, we talked about that. You may qualify if the area qualifies, that is, and you qualify. There can be a 0% down payment, kind of similar to the VA loan. And we talked about the VA loan, which is through the Veterans Administration of Veterans Affairs, and that's only through active military veterans and spouses. And so the advantage there could be no mortgage insurance, closing costs do not exceed 1% of the loan amount. And so there was some of the key elements to some of those loan choices. And then moving on to cash on hand was a HELOC, which is a home equity line of credit. That's something that you can get by utilizing equity in your home and can be done through your bank where you hold your mortgage, maybe the same person that's handling your mortgage. And then we talked about alternative lending or hard money as another way to go through private investors and companies. And there's a wide variety of services and products that can be handled through alternative lending or hard money. So financing is very important and a necessary step in the real estate process, in addition to many other areas, including personal use and business use in the form of operating capital. So I hope you found this short video educational and helpful in your life journey. Your bank or mortgage lender will be most valuable in answering any additional questions that you may have in these areas. Outside funding like hard money and alternative lending, you can also give me a ring if you have any questions on that. And I want to thank you for watching your Real Estate Doctor channel. Please like and subscribe. You may enjoy some of my other videos, so as usual, I will attach a link below to have you ever wondered what it might cost if you sold your home in Naples, Florida? Have you ever wondered what it might cost if you sold your home in Naples, Florida? Feel free to comment below or reach out to me with any questions on these topics. You can reach me at 239-331-5886. That's 239-331-5886. I am Dr. Ron Repasy with Realty One Group Paradise. Blessings to you, wishing you peace, health, and happiness, and we'll catch you next time. Boom.